Hare Krishna. Welcome to Tax Guru YouTube channel. This is CA Rohanar Pingre, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to video series GST Relearn. Yes, and today onwards we are heading to module 2. In last module 1, we have covered 6 topics: definitions, important definitions, and supply under GST, then charge under GST, place of supply, exemption, time of supply, and value of supply. So now today is the 7th part, and we are going to discuss very important part today is ITC under GST. So let's dive into it. Let me allow to share my screen. Concept of ITC under GST. Let's see what we are going to learn today. Key references: Section 16 to Section 21 of CGST Act, Rules 36 to Rule 45 of CGST Rules. We are touch upon each rules, each sections today in this topic. So you will have a basic and better understanding. If you want, you can go ahead and deep dive into it. But today in this, we will touch upon every rule and every section, and you will have a basic understanding of it. So then section 16 is talks about eligibility and conditions for taking input tax credit. Section 17, apportionment of credit and block credits. Section 18, availability of credit in special circumstances. Section 19 talks about taking input tax credit in respect of inputs and capital goods sent for job work. Section 20 talks about manner of distribution of credit by input service distributor, that is known as ISD. Section 21 talks about recovery of credit distributed in excess or wrongly distributed. And then we will move on to rules. Rules 36, documentary requirements. Rule 37, reversal for non-payment within 180 days. Rule 38 talks about reversal by banking companies. Rule 39 talks about ISD distribution, that is input service distributor credit distribution. Then Rule 40, reversal for capital goods. Rule 41, transfer of credit on sale or merger. Rule 42, apportionment of ITC, that is inputs and services. Rule 43, apportionment of ITC capital goods. Rule 44, ITC on stock in case of exemption, cancellation. Rule 45, job work procedures. And at the end of the session, we will see key takeaways from today's learning. So stay tuned till the end of the session. And in each topic, subsections, in each section of today's video, we will see also practical example to have a better understanding. So let's start with it. Input tax credit is a mechanism that allows a registered taxpayer. To whom? A registered taxpayer. ITC is a mechanism that allows a registered taxpayer to claim credit for GST paid on its purchases like inputs, input services, and capital goods. All three are covered, okay? Which can be used to offset GST liability on outward supplies. It eliminates the cascading effect of tax, that is tax on tax, and ensures a seamless flow of credit throughout the supply chain. Okay, that is the main crux of it. What is meant by ITC? ITC is a mechanism that allows a registered taxpayer, not unregistered, registered taxpayer, allows a registered taxpayer to claim credit for GST paid on its input services, and capital goods, which can be used to offset GST liability on outward supplies. It eliminates the cascading effect of tax, that is tax on tax, and ensures a seamless flow of credit throughout the supply chain. Key references: Section 16 to Section 21 of CGST Act and Rules 36 to Rule 45 of CGST Rules. What are the key points? ITC is available only to a registered person. Only to a registered person. Tax must have been paid by the supplier and reflected in GST R2B. Here and is used. Okay, so the both conditions need to be fulfilled before claiming ITC. What is it? Tax must be paid by the supplier and reflected in GST are to be returned. Then only you can rightfully claim that particular ITC. Okay, let's see example. If a manufacturer buys a raw materials worth rupees 1 lakh plus 18,000 GST and sales finished goods of rupees 2 lakh plus 36,000 GST, the ITC of 18,000 is available, reducing cash liability to 18,000, that is 36. This is our output tax, output liability minus we will claim this ITC, that is we have paid on our purchase. So our net liability will be rupees 18,000. Okay. This is a concept of ITC. Let's move on section 16. What section 16 talks about? Eligibility and conditions. Eligibility and conditions for taking ITC. Let's see. Entitles registered persons to ITC on goods or services used in business. You cannot claim ITC on your personal business or personal use. You are using those goods or services or personal use, then you cannot use that particular ITC in your in respect of your business or in profession. Okay, for example, if you are purchase any clothes or uh, any item for your home use, then if you have paid GST on that particular item, you cannot use that ITC to pay your output liability generated in from your business or profession. Okay, conditions: possess a tax invoice or debit note, receipt of goods or services, receipt of goods or services, tax actually paid by supplier, ITC claimed in return within time limits, and payment to supplier within 180 days. That Rule 37 talks about is payment to supplier within 180 days. Else, if you are not paid, then you have to reverse that ITC after that 180 days period. Means 181st day, you have to reverse that ITC if you are not paid. Okay. So what are the conditions? Mainly tax invoice or debit note should be there. You have received goods or services, tax actually paid by the supplier, ITC claimed in return within the time limits, and payment to supplier within 180 days. Let's see example. A trader buys goods worth rupees 1 lakh plus GST 18,000. Supplier files R1, GST R1 return, that is his sale return, and pays tax. Trader can claim rupees 18,000 ITC provided goods are received and payment is made. Provided goods are received and payment is made. Means all these conditions need to be fulfilled, not only one of that. You must possess a tax invoice, you must receive the goods or services, you need to see the tax actually paid by the supplier, ITC claimed in return within the time limits, and payment to supplier should also be made within 180 days. Okay. Let's move on section 17, apportionment and block credits. ITC must be apportioned For mixed taxable plus exempt supplies, ITC must be apportioned. If you are supplying or taxable and exempt goods, then you must apportion that ITC between taxable and exempt supplies. You need to be differentiated. You must keep on record those factors giving you the apportionment of taxable plus exempt supplies if you are dealing in mixed supplies. List of block credits are motor vehicles, personal use. As I have said, you cannot use ITC paid on items or products you are using for personal purposes. Okay, immovable property, food or beverages. These are the block credits. You cannot use ITC related to these items. Motor vehicles, personal use, immovable property, foods and beverages. In case of motor vehicles, when both are dealing in the same supplier and seller or purchaser, both are dealing in motor vehicles, then there are few of the that you can use that ITC. But otherwise, these are the block credits. You cannot use ITC under any of these covered goods or services. Okay. Next, example before moving to section 18. If common input services audit fees worth rupees 1 lakh plus GST 18,000 benefit both the taxable and exempt businesses, ratio 2 as to 1, only rupees 12,000 GST can be claimed and rupees 6,000 reversed. Why? If common input services audit fees worth 1 lakh 18,000 is GST, benefit both the taxable and exempt business, that ratio would, if it is 2 as to 1, then only 12,000 of GST can be claimed and 6,000 would have to required to reversed. There are concept of availed and utilized, means you can avail that ITC, but you cannot utilize, and before that utilization, you have to reverse that. Okay. Next, section 18, availability in special circumstances. What are they? ITC allowed when registering, switching from composition, or when exempt supplies becomes taxable. These are the special circumstances. What are they? While registering, switching from composition, or when exempt supplies become taxable. Let's see an example so that you will be very clear on that. A manufacturer converts from composition to regular on 1st July, stock with GST of rupees 50,000, eligible as ITC if invoice is not older than 1 year. Very clear. What and if manufacturer converts from composition to regular on 1st July, stock with GST of rupees 50,000 eligible as ITC if invoices not older than 1 year. Okay. Section 19, ITC for job work. Principal can claim ITC on inputs into job worker. Inputs must be returned within 1 year. This is a condition. Means principal can claim ITC on input sent to job worker, but what is the condition? Provided input must be returned within 1 year, 3 years for capital goods, or treated as supply. ITC for job work, principal can claim ITC on input sent to the job worker, but what is the condition? Input must be returned within 1 year, and in case of capital goods, it is 3 years, they must be returned or treated as supply. Example, machinery sent to job worker on 1st April 2024, if not returned by 31st March 27, deemed supply, taxable supply. Okay, means if you not fulfill this condition of returning of these inputs within 1 year or 3 year in case of capital goods, then at that time this would be treated as your supply and you must be required to pay tax on that day. Okay, so example is machinery sent to job worker on 1st April 2024. If not returned by 31st March 2027, then it will be treated as deemed supply and tax will be paid. Section 20 talks about ISD mechanism, that is input service distributor. Head office can distribute ITC for common services to branches, distinct persons via ISD invoices. Distribution pro rata based on turnover. It is also given how you can distribute the credit on the basis of pro rata of turnover. Let's see an example. HO receives legal services worth rupees 2 lakhs plus GST 36,000. Branch turnover is like A 50 lakhs, B 30 lakhs, and C 20 lakhs. Then ITC distributed would be in the ratio of 50, 30, 20. That is 18,000, 10,800, and 7,200. Total comes to rupees 36,000. Hope you are clear because we are also going to the examples, practical examples. So how ISD mechanism works? Head office can distribute that ITC for common services to branches, that is distinct persons via ISD invoices, and distribution should be on the pro rata based on the turnover. Like in the example, HO receives legal services worth rupees 2 lakhs plus GST rupees 36,000. Branch turnovers ABC would be 50, 20, and 20 lakhs respectively. Then ITC distributed in that ratio 50, 30, 20. That is 36,000 ITC will be distributed to A, B, and C in 18,000, 10,800, and 7,200. Next, section 21, recovery of ITC. Wrongly availed ITC is recovered with interest and penalties under Section 73 or 74. Section 74 covers fraud cases and Section 73 covers other than fraud cases. Okay. Whenever there is a recover of ITC, any reason that availed ITC means that wrong availed ITC is recovered with interest and penalty under Section 73 or 74. Example, a company avails rupees 5 lakh ITC on ineligible items like motor cars. Okay, and that company may not be dealing in motor car. Therefore, that ITC need to be reverse on detection must be reversed rupees 5 lakhs plus interest and may face penalty. If it is a wrongful with the knowing facts, if there is a means re, then that should be covered under the section 74. And if it is not, then it is other than fraud cases that section 17(3) interest and penalty will be leviable. And now we will move on to rules. Rules 36, documentary requirements. ITC based on tax invoice, debit note, bill of entry, or ISD invoice. These are the major 4 documents. That is the documentary requirements you have to keep with you to claim your ITC. That is invoice, debit note, bill of entry, ISD invoice. These are each separately. You can claim ITC on the basis of these documents. Example, ITC on imported goods can be claimed based on bill of entry even before supplier files GST R1. Very important. What? ITC on imported goods can be claimed based on bill of entry even before the supplier files GST R1. Next, Rule 37. Rule 37 talks about reversal for non-payment within 180 days. That is, if you have not paid your if you are not paid to the supplier within 180 days time, then that taken ITC need to be reversed. If recipient fails to pay supplier within 180 days, ITC must be reversed with interest. Example, invoice rupees 1 lakh plus GST 18,000 unpaid for 200 days, more than 180 days. Reverse of rupees 18,000 plus interest for 20 days delay. Delay is how much? 180 days. So your calculation of interest would be based on that 20 days. Okay, it is not covered all the days. It will be required to pay the interest and penalty on the days we have exceeded. Okay, so we have to pay 20 days in given exam. Rule 38, reversal by banking companies. It is a separate rule for the banking companies to reverse their ITC if any availed wrong. Banking or non-banking financial companies can claim 50% of total ITC without apportionment. Example, a bank with rupees 10 lakh ITC claims rupees 5 lakh directly without detailed calculation. Very simple mechanism given to the banking industries that they can claim 50% of total ITC without any apportionment. So a bank with rupees 10 lakh ITC can claim 5 lakh directly without a detailed calculation. And the balance will need to be reversed. That is Rule 38 talks about that. Rule 39, ISD distribution prescribes formula for distributing ITC by ISD. That is, we have seen one formula is that you have to distribute that ITC on a pro rata basis based on the ratio of turnover of the branches. Okay, let's see example. ISD receives GST 90,000 for services. Turnover of units A is to be 60 is to 40. So distribution will be in the ratio of 60 is to 40. That is rupees 54,000 for A and rupees 36,000 for B. That is the ISD distribution. Rule 40, reversal for capital goods. You can go and see in detail for the formulas and the number of situations. This here I'm covering, I'm touching upon the basic concepts so that you will be hang on that and a little bit confidence you will gain from this learning. So this is what my aim is. Okay. Rule 40, reversal for capital goods. ITC to be reduced proportionately if capital goods partly used for non-business or exempt supplies. Okay, means whenever you used capital goods and if you are a supplier of both non-business and exempt and taxable supplies, then that use of capital goods, that ITC on capital goods need to be reduced proportionately. Whatever that you are using in your non-business or exempt supplies, and only the portion you are using in taxable supplies, that ITC will be available to you, and the balance need to be reversed. So let's example is capital goods of GST 1 lakh rupees 20,000 used 75% to for taxable supply. So only 90,000 will be allowed and rupees 30,000 reverse, as your 75% is using for taxable and 25% is your non-business or exempt. So the 25% need to be reversed. That is the reversal for capital goods under Rule 40. Rule 41, transfer of credit on sale or merger. Allows ITC transfer via from GST ITC 02 when business is sold or merged. This is a situation when one sell his business or merge with another company or another entity of its business, and that time how to apportion or transfer that credit to the taking over party or taking over person. So allows ITC transfer via form GST ITC 02. You have to use GST ITC 02 to transfer that credit to the succeeding person. So example, a company merges unutilized ITC of rupees 2 crore transfer to new entity via ITC form 02. Okay. When you use this ITC 02 and promptly transfer this credit using this ITC, then only you can use that ITC by that succeeding company. Means on portal, this must be reflect. Rule 42, apportionment of ITC, inputs and services. And Rule 43 talks about apportionment of ITC on capital goods. Rule 42 talks about apportionment of ITC, inputs and services. Prescribes formula, as I said earlier, for reversing ITC used both for taxable and exempt supplies monthly. It is not like straightforward. There is a formula you need to check afterwards. That formula reversing of ITC used for both the taxable and exempt supplies on month-to-month basis. Example, total ITC rupees 1,80,000, exempt turnover 25%, taxable 75%, reverse 45,000 proportionate to exempt supplies. Rule 43, apportionment of ITC, that is capital goods, similar to Rule 42, but over 60 months for capital goods. Similar to Rule 42, but over 60 months for capital goods, that is 5 years. Example, GST on capital goods of goods of 6 lakhs used 40% for exempt supply. Reversal would be 6 lakhs into 40% divided by 60 months each period. It is apportioned into 5 years, that is 60 months. So GST on capital goods of 6 lakhs used 40% for exempt supply, then reversal will be 6 lakhs into 40% divided by 60 months each period. Rule 44. ITC on stock in case of exemption or cancellation requires reversal when exempting or cancelling registration. ITC in stock in case of exemption or cancellation requires what? Reversal when exempting or cancelling registration. If GST stock credit is rupees 1 lakh at cancellation, ITC reverse via GSTR 10 of amount to rupees 1 lakh straight. For that reversal, you have to use form GSTR 10. Let's see Rule 45, job work procedure. Very important. ITC allowed for goods sent for job work subject to return within timeliness. That is 180 days is a base criteria. ITC allowed for goods sent for job work subject to return within timeliness. Example, input sent to job work for 10 months. ITC continues as long as return within 1 year. Input sent to job work for 10 months. ITC continues as long as return within 1 year. And now we are moving to key takeaways for effective ITC management under GST. Hope you have understood what from section 16 to section 21, 22 covers and rule 36 to 45. Okay, just have a glance. Section 16 talks about eligibility and conditions. Section 17, apportionment of credit and block credit. Section 18, availability of credit in special circumstances. 19 talks about taking input tax credit in respect of input and capital goods sent for job work. 20 talks about manner of distribution of credit by ISD. 21 talks about recovery of credit distributed in excess or wrongly distributed. And Rule 36 to Rule 45, that is 36 documentary requirements. Rule 37 talks about reversal for non-payment within 180 days. 38 talks about reversal by non-banking company by banking companies. Rule 39 talks about ISD distribution. 40 talks about reversal for capital goods. 41 talks about transfer of credit on sale or merger. 42 talks about apportionment of ITC inputs and services. 43 talks about apportionment of ITC capital goods. 44 talks about ITC on stock in case of exemption or cancellation situations. And Rule 45 talks about job work procedures. And now we will move to key takeaways from today's topic, that is ITC. Eligibility depends on compliance, that is tax invoice, a receipt of goods or services, supplier tax payment, and timely claim are mandatory. Timeliness are strict. ITC must be claimed by September of the following financial year or before filing the annual return, which with debit note timeliness linked to the note date, section 16, subsection 4. Block credits remain significant. ITC on personal expenses, immovable property, motor vehicles, and certain services is disallowed. That is section 17, subsection 5. Apportionment is pretty crucial. Common credits must be split. Common credits must be split proportionately between taxable and exempt supplies. with monthly and long-term calculations. That is rule 42 and 43. One is for input and services and one is for capital goods. ISD helps centralize credit flow. Head office can distribute ITC to branches based on turnover ratios. How turnover ratio is very important. Say job work and special cases. ITC continues for goods sent to job workers, but timeliness from return must be followed. That is 180 days under section 19 and rule 45. Non-payment triggers reversal. If supplier payment is not made within 180 days, ITC must be reversed with interest, which is the rules referred to rule 37. Wrong ITC is recoverable. Erroneous claims attract interest and penalties under section 21. That is wrong ITC is recoverable with interest. Reconciliation is not negotiable. Regular matching of books GSTR 2B and GSTR 3B avoids disputes and protects credit. Very important. So filing with the documentation is also mandatory. Okay. Practical examples help compliance. Applying statutory provisions to real scenarios simplifies what understanding and prevent errors. And therefore, in each section of today's discussion, we have also went through various practical examples so that you have better understanding of the topic. So this is for the today. We have covered ITC concept. We have touched upon the basic of understanding of ITC. Hope you are learning and growing. So if you like this video, then do share with your network. Subscribe to Tax Guru YouTube channel for daily updates like this. Stay tuned for various series and various updates. We'll meet soon. Hare Krishna.